All right, we can begin in about 60 seconds. My name is Jacob Gaffney, and I'm moderating today's webinar, Unlocking Home Equity Strategies for Mortgage Brokers. I'm joined by Steve and Michael. Let's give everyone about 1 minute to join us, if that's okay.
Absolutely.
Great, and then we'll kick it off. Gentlemen, you have the opportunity to introduce yourselves fully. Talk a little bit about what we have in store for our guests today. Very exciting time in the market, to say the least. Very interesting market as well. We're joined by two amazing experts that I've had the honor of speaking to about home equity strategies. A very important time now more than ever. I think recent equity reports and recent home price indices have surprised to the upside. So now is more important than ever to discuss this. And I think we've given everybody a chance to join us, and we're getting ready to kick this off. Gentlemen, are you ready to start your engines?
Well, absolutely.
Good to go.
Thank you so much. Again, today's webinar is titled Unlocking Home Equity Strategies for Mortgage Brokers. I'm joined today by two experts in the market. My name is Jacob Gaffney, and our experts are Steve and Michael. Steve, let's start with you. Let's do a quick introduction before we dive into the slides. Tell us your full name, and I used to be editor-in-chief in Housing Wire, and I knew you very well when I was there. So let's introduce you to all of our other guests.
Yeah, hey, welcome everybody, and thanks for taking the time out of your day to listen in and watch as we step through this presentation. I'm Steve Irwin, President of National Reverse Mortgage Lenders Association, based here in Washington, D.C. Normala is the national voice of the reverse mortgage industry. We have over 250 member companies and over 2,400 member delegates. Normala serves as an educational resource, a policy advocate at the state and national level, and a public affairs center for reverse mortgage lenders and related professionals. Our mission includes educating industry participants on best practices, regulatory requirements, and market dynamics, providing helpful information to consumers about reverse mortgages, and enforcing our code of ethics and professional responsibility, and offering insight to policymakers who are working on reverse mortgage matters and related issues. Normala members make up over 90% of the reverse mortgages originated in the marketplace today. So thank you, everybody. Nice to meet you all, and hand it over to Mike.
Hi, everybody. It's Mike Pearson with A&D Mortgage. I've been in the industry for over 20 years now. So I guess 22 years now. So we've seen a lot over the last 20 years. Excited to be joined with Steve. Excited to have this conversation about equity and this time of rising rates, but people still wanting to access equity and use it for a number of items. And we'll dig into some of that in a little bit. And then I'll cover a little bit more about A&D Mortgage specifically in just a minute, but that's a little short intro on me.
Excellent. Thank you both, gentlemen. Let's go ahead and hop right into it. I think we got a very, very exciting agenda that we're going to go through. First of all, we need to talk about why we're here and why it's important, and why A&D put this together and brought us all in the room. So we'll hand it over to Michael a little bit to talk about it. We've already covered our featured speakers that we've introduced. You can kind of see the rundown of the options to access home equity that can be at your beck and call. But I want to go over a little bit of etiquette. Right now, please type any of your questions into the chat. I will moderate them. I will get to them once we finish the presentation. Please turn off your cell phone so we don't hear any unnecessary pinging. If your cell phones do ping, we're just going to go right through it. So don't worry. Don't freak out, but just it's a matter of etiquette, but it's okay. Everyone will receive a copy of this presentation. We'll send it out about 24 hours after we're concluded. So with that said, all that out of the way, we're going to go right into it. We've already introduced our speakers. And Mike, why don't you tell us about A&D Mortgage?
Sure. Yeah. Thanks a lot. No, yeah. So A&D Mortgage, if you're not familiar or already doing business with us, is a large nationwide mortgage company. What you may not know is it's really a family of companies with A&D Mortgage and also Imperial Fund, which is a fund that we've grown into that helps purchase A&D's mortgage loans, but also other mortgage investments and stuff as well. It makes us really differentiates us in the market, being able to purchase, securitize, do our own business, write our own guidelines. It also helps us to expand and license across the U.S. And we'll go through that map here in just a second. So yeah, if we can go to the next slide, Jake. Yeah, so a little bit about what makes us different, our value proposition, right? So it really started with an innovative product line, looking at what would make us a little bit different in the marketplace. We started looking at non-QM, non-agency offerings, and then we try to take a look at where people are successful in this business, and that comes down to process and speed, right? So looking at the streamlining the process to make things move more smoothly and a little bit quicker, working on advancing technology to make the experience in the non-agency world the same as you would have in the conventional reverse world. All those streamlining and advancement in technology has helped us stay very competitive and be able to offer a great compensation plan for the customers that work with us. And then our focus on training, we say onboard processing, right? That's a continuous process of training like we're doing today, learning about other options and things within the industry, and then also the program set that we offer. So we like to think that that's kind of a total package of what we offer and what we can do for our clients. Moving on to the next slide, we'll talk briefly on our footprint and what we do there. So we are a full service mortgage lender. So we do offer wholesale correspondent lending. We do our own servicing. I actually, about 100 feet from where I'm sitting right now, there's about 20 of our servicing staff. So they're always here to help out with any loans that we've closed and we service and hold on to. As you can see from the map, we lend pretty much across the U.S. I think we have about 7 more states that will be fully licensed in the next maybe month or two. So there's a lot in the works there. Obviously, we purchase correspondent loans across the U.S. And there are plenty of states, whether we're licensed there or states that allow for business purpose loans that we can lend in as well. So, and then all this information, of course, you can find on our website as well, admortgage.com. All right, so let's get into today's topic is actually on home equity in 2023. So we're going to have a conversation on, all right, so we're in a rising rate environment. We're in a situation where people have a lot of equity. Now, what do they do? How do they access it? How do they use it in the rate environment and everything that we're in right now? So a few statistics. I'm not a fan of reading through an entire presentation, so I'll skip around. Again, like Jacob said, you're going to get a copy of this presentation, so you can read through this stuff bullet by bullet. But I found it very interesting to see that, some places in the news, it sounds like we're crashing and everything is going down, everything is crazy. But the change in equity over the last year has actually been pretty minor, less than 1%. And again, a lot of that is regionalized, as we'll see here in just a second. So there is still a lot of equity. There's still a lot of money that borrowers have saved up through the last couple of years that they may want to access. Can we move on? There we go. Again, this covers a lot of the same topics. So as you can see in the first quarter of 2023, the homeowners have lost a small amount of equity, but they still have, a ton. I like looking at the quote from Selma Hepp on the right-hand side. Interesting to note that the average borrower has $274,000 in equity, which again is up almost $100,000 since pre-pandemic. So there's a lot of money accessible within properties for people that have mortgages. And again, there have been some slight declines in some areas of the country. Other areas of the country, we still continue to see increases. So, that just kind of leads to all that. Okay, move on. All right, I thought this was a great map, so I really appreciate the graphics and really seeing the visuals on this. Again, even in states like California, where you see an overall decrease of 60,000 in net equity, those pockets of the state that's the case. There's other pockets where there's still increases in volume, right? So you really got to drill into the areas that you're doing business. But overall, you can see on the West Coast, there's probably a slight decrease in values overall. In the Midwest, holding fairly steady. The Northeast is kind of depends on what state you're talking about. In the Southeast, it's still fairly strong growth. Certainly the West Coast to this point has been hit the hardest. And then as you see at the title of the slide, use it or lose it, right? So if things continue to trend the way they are, we could likely see, continue, some gain losses moving forward. So the time to act is now, and that's kind of why we have this conversation and why we're going through these topics. So let's go into some home equity options, right? So I think most people know what a cash out refinance is, although we'll cover that on here. We're also going to go through second mortgages, both fixed rate second mortgages, like the product that A&D offers. We'll also talk a little bit about home equity lines of credit or HELOCs that we don't currently offer. We'll talk about cash out refinances, and Steve will finish us up with a good conversation on reverse mortgages. All right, so second mortgages. Again, when we're talking second mortgages here, we're talking about fixed rate second mortgages. All right, so a second mortgage is a loan that's taken out against the equity of your home while keeping your existing mortgage intact, right? So this is very important for a lot of homeowners who had very low sub 3% interest rates a couple of years ago. They want to pull out equity to add on to a home, buy another property, whatever the case may be. But they want to leave that first mortgage alone. They have all this equity, but we're in a rising rate environment and may not want to refinance their first mortgage and turn a 3% interest rate into 6, 7, 8% interest rate, right? So they can access a second mortgage, a fixed rate second mortgage. The guidelines that you see here are primarily A&D mortgages rates are guidelines. So you can see we require a 660 score. We go up to an 85% CLTV. We do them on all occupancies. We go down as low as a $50,000 loan on these programs, as high as $500,000, and we've gotten several of those recently. We do allow up to a 50% DTI. On top of that, we can also do DSCR loans on those, so you wouldn't have DTI in that situation. And these are 30-year fixed loans. I will note, it's the last comment on here, we do not do cash out refinances in Texas or New York. Otherwise, it's acceptable in all the states that we can lend in. Okay. So the home equity loans. So this is, again, a fixed rate loan with one lump distribution done at closing. So they want $200,000, they get $200,000. Where that differs to a line of credit is much like a credit card, right? They might take an initial draw of some amount and have some flexibility to draw out more during the draw period of that loan. So it gives them the flexibility to do both. Once that draw period is lapsed, however, it does revert to a traditional payment schedule, usually on a shortened schedule. So the payment can go up quite a bit from during a draw period. It's usually an interest-only period, and then reverts to an amortization period, which is, again, usually shorter. So you'll have an increase in payment depending on what they've paid on it during the life of that loan. All right, so some of the benefits to a second mortgage. Again, we're talking about a fixed rate second mortgage here. So you can access a large amount of money. All right, so second mortgage to provide substantial funds for major expenses. Again, these are the things that we see: home renovations all the time, debt consolidation, maybe purchasing additional properties. Those are things that we see a lot. I don't know anything about tax advantages. I don't get into that. Obviously talk to a tax consultant when it comes to that, but I guess there's some potential for some tax savings through these mortgages as well. Things to consider: increasing debt burden. Taking out a second mortgage obviously means you're getting additional obligations, right? So you have an additional monthly payment to worry about there. And then also the risk of foreclosure. Like any other mortgage, if you default on a second mortgage, the lender can file for foreclosure. All right, so let's talk for a second on home equity line of credits, or HELOCs. Right, so a HELOC is a revolving line of credit that allows you to draw against the equity of your home. So again, we talk in terms of, think of it similar to a credit card, right? So you draw out a certain amount, you grow a balance, you pay interest based on the balance that you use during that time period. Now, HELOCs can differ quite a bit. the draw period timing, how many draws you can take, what kind of distributions you can do. So when you get into those programs, it's very important that you understand how they function for that individual one. There's not one, and they all work the same way. Each one can kind of have different terms and schedules there. So it's important that you read the guidelines and understand how those work. And then the interest rates on HELOCs are variable. So they're usually based on the prime rate. So they can adjust over time depending on economic situations. So again, it's important to understand what the interest rate is based on. Again, just like a credit card, that can vary based on the balance that you're carrying on that HELOC and then based on the economic situations on the ground. Benefits of HELOCs, flexibility, obviously. You can use the funds as needed. And only pay interest on the amount that's borrowed. So you're paying not on the total loan borrowed, but what you've actually pulled out of that HELOC. There can be initial costs that are slightly lower than other mortgage products. And again, potentially tax advantages. But you know, I don't dip into that. So tax consultant on any of that stuff. All right, considerations for HELOCs. We brought this up earlier, right? So variable interest rates. So these rates can change on a monthly basis. So it's important to understand that. It's important to understand and that they're monitoring where the rates go on those programs. You know, we also have on here the potential for temptation to overspend. Much like a credit card, when things are easy, sometimes it gets overused. So it's important that borrowers understand what they're using the money for and they're being responsible just like any other product. And just to put it out there, we mentioned it earlier, but I want to make sure everyone understands today, A&D Mortgage does not do HELOCs. We're working on that program, but it's not something that we offer today. All right, next up is our standard cash out refinance. Obviously, a cash out refinance is a loan that would be replacing an existing mortgage or maybe a property that's free and clear, bringing on new debt and being able to draw that equity at the same time. The difference between the new loan amount and the remaining loan balance is the cash taken. And then interest rates on cash out refinances are typically lower than those of a second mortgage or a HELOC. Since it's a first lien position on the property, they generally have a lower interest rate. Benefits of a cash out refi. Again, access to substantial funds. So again, they're doing the new mortgage. The amount of cash that they draw out of there can come out of that loan as well. And then potential for lower interest rates. You know, we don't see that a lot right now, but as rates change and potentially rates go down, you could have an opportunity to refinance into a lower interest rate and be able to grab some additional equity out of the property at the same time. All right, next up is our considerations for cash out refinance. Of course, you'll have new closing costs on the new refinance. So make sure that they're disclosed and understand the closing costs that'll be factored into the decision making on whether or not to go into that mortgage. And then also you have resetting loan terms, right? So you could have a potential where a borrower is paid several years into a loan and turn around and starting the loan back over, right? So again, this all comes to that, conversation with the client, help them understand the borrowing choices that they have ahead of them and what's the right choice for them and their goals moving forward. All right, next up. Oh, I get to pass this on to Steve. I'm getting my notepad out. I'm ready to take some notes. That's all you, Steve.
Well, thanks very much. And whenever I introduce the topic of reverse mortgage, I generally like to set the stage a little bit. That stage setting will involve reminding people that there are some 10,000 people a day turning 62 years of age and older. And it is anticipated that this trend will absolutely continue for the next 19 years or so. Normally, our trade association has partnered with RiskSpan, and several years ago, we created something called the Normala RiskSpan Reverse Mortgage Market Index to track how much equity is being held by senior homeowners. And as of the end of last quarter, America's seniors are holding some $11.6 trillion in home equity. There are over 26 million senior homeowners in the US as of the end of last quarter. This is a huge opportunity for the reverse mortgage space, but as I like to remind our members, that opportunity is not a destiny. Fundamentally, reverse mortgage is for borrowers who are 62 years of age or older. There are some private label products and proprietary products out there that will go down to 55 years of age. But the most common type of reverse mortgage in the marketplace today is indeed the FHA, insured home equity conversion mortgage, or HECM. And there have been some 1.3 million HECMs originated since that program's inception. The collateralized property must be the primary residence of the borrower. And a borrower can establish periodic monthly payments or create a line of credit to draw on as they so desire. Or if we could just go back, well, we can stay right here, but or they can create a combination of line of credit or monthly payments. I would note that on the prior slide, it referred to reverse mortgage proceeds. And just a moment, I just want to point out that these are a loan. Reverse mortgages are a loan, and we try to stay away from saying that we are converting home equity into income. And we may want to adjust this slide before distribution. These are loan proceeds that will have to be paid back eventually. Okay, thanks, Jake. If we can get the next slide. Yeah, so the most common use of a reverse mortgage today is certainly paying off an existing mortgage, where in our world, we kind of think of them as forward mortgages, but paying off regular mortgages, thereby alleviating the burden of monthly principal and interest payments. We are also, however, seeing a definite trend of more and more senior homeowners out in the marketplace setting up standby lines of credit. And these standby lines of credit are mainly for financial planning purposes, to smooth out volatility in their financial portfolio, or to be available should there ever be a shock to a senior homeowner's income stream. They can then turn to the house and start borrowing against the equity they've built up there. And if we can move on to the next slide, Jake, please. Yeah, and so there are a lot of benefits, a lot of uses for reverse mortgages. Unlike a HELOC, which was discussed a couple minutes ago, a reverse mortgage does not require any monthly payment of principal or interest. And also, unlike a HELOC, a reverse mortgage cannot be suspended or called due based on changing macroeconomic conditions or changes in the borrower's estimated home value. In fact, the unused portion of a reverse mortgage borrower's line of credit will increase over time. We like to think of it as just more available credit, like an increase in a credit card. As that borrower ages, more proceeds become available over time. And of course, a borrower can always choose to sell and move, but most seniors definitely prefer to age in place. So reverse mortgages are a great way to diversify your portfolio of product offerings. So it's another arrow to have in the quiver. As I mentioned, the opportunity is there. The ability to establish flexible methods of accessing that equity through a variety of payment plans, which over time can be changed. And you can move from a line of credit to monthly payments, etc. You just work with your servicer. But that being said, there are obligations. And if we could move to the next slide. So the homeowner must maintain the property, must pay property taxes, and keep up with homeowners insurance and home maintenance. The reverse mortgage is a non-recourse loan, and at no time will the borrower or the estate owe more than that property is worth when that loan becomes due and payable. And therefore, the lender needs to make sure the collateralized property is protected, that it will not be seized by a taxing authority, or if there should be some disastrous event, that there's proper insurance in place, because again, it is only the property that a lender will look to get repaid. And next slide, please. Yeah, and so as I mentioned, the majority of the product originated in the marketplace today is the FHA HUD insured mortgage, and HUD absolutely wants to make sure that the borrowers can effectively and efficiently age in place. Back in 2015, there was a financial assessment implemented, which is sort of a light underwrite, as just to ensure that after utilities obligations, home maintenance obligations, HOA dues or condo dues, utilities, drug prices, that there is enough residual income for that borrower, even with the proceeds of the reverse mortgage, to effectively age in place. As I mentioned, tax and insurance are a responsibility of the borrower. However, a borrower can opt to have those obligations paid by the servicer through the creation of what is known as a set-aside account. It's not really an escrow because there are no payments going into this, but it is a set-aside from the calculated available proceeds, which would then over time go to pay taxes and insurance. Again, no principal and interest payments are required as long as the borrower obligations are met and the collateralized property remains the principal residence of at least one of the borrowers. And that is a reverse mortgage in a nutshell. I don't know if there's another slide or if we're moving into questions. And I'd be happy to entertain any and all questions that anybody might have.
Thank you for that, Mike and Steve. The one question that we have would be if AD is considering ever offering reverse mortgages, or what could be the timeline there. You had mentioned that HELOCs were in production. Do we have an update there?
Reverse mortgages, not specifically today. I know we're looking at several different programs. We're always expanding our program set to be viable for our customers. At this point, we haven't started working on reverse mortgages. There's plenty of great lenders and people that offer reverses. So if they make an inquiry, I'm sure we can connect them with someone, or Steve can get them involved with the association there and get plugged in with a great lender.
Perfect. And Steve, tell me a little bit about what happens when, in the untimely event that a homeowner passes away with a reverse mortgage. Do their children have the opportunity to take over the obligation and keep the property, or what is just the typical way it gets resolved in that?
Typically, the heirs or estate will sell the property, and the balance owed on the reverse mortgage is paid, and then any remaining equity goes to those heirs and to the estate. All that is owed is balance of accrued principal and interest and mortgage insurance. So yes, the heirs or estate, if they want to remain in that property or they want to keep that property, can simply pay off the balance owed on the reverse, and they're good to go. Or they are free to refinance and get their own mortgage, but they cannot assume the reverse. The amount of proceeds made available is based on property value and age of that borrower at time of application. So an estate can't assume it, but they can certainly refi and pay the loan off, or sell and pay the loan off as well. We're finding that it's something like between 60 and 70% of reverse mortgage borrowers, the collateralized property is not the property where the children were reared, nor is it in the property where is the property in the community where the children or the estate and heirs currently reside. So typically the estate will sell the property and pay off the obligation from there.
And that's great. Thank you for that. I do wish to clarify to everyone that, you know, we're not financial advisors by any means, but it seems like a good consideration, like anything else, to look at reverse mortgages. But that's really more of a segue into my question for Mike. Again, I'm not a financial advisor, but I want to run a scenario by you to kind of
boy. Okay.
get your expertise. Don't mean to put you in the hot seat, but you mentioned rates. You mentioned rates are pretty high.
Mhm.
That's true. People need cash. People need to sometimes get second jobs to afford their primary mortgage with these elevated interest rates, unprecedented, unhistorical. Would it ever make sense to get a HELOC now, and then when rates get lower, refinance both of the loans into one loan in a refi?
Yeah, we're actually seeing that quite a bit right now, specifically to our second mortgage, because again, I'm not doing HELOCs today, but we see that a lot with the second mortgage, right? We want to access the equity, right? There's things that we want to do with the money. We want to make investments. We want to set up, you know, future for our children, you know, whatever the scenario is for the borrower, right? So they want to access the equity, but they understand that we're in a rate environment that, you know, maybe they don't want to refinance right now, or maybe they want to wait and see what happens with interest rates. So yeah, we see that a lot right now. So people are taking a second mortgage, and down the road, if rates trickle down into a range that would you know, put them in a good situation and still be able to qualify, then they could combine that first and second mortgage and pay that off into a new mortgage. Historically, that's been done a lot when we went through this you know, downturns before. And again, just to put everything in perspective, I mean, the rates are up, but you know, if you look over the lifespan of offering mortgages, you know, it's not extreme. It's just difficult when you're used to rates being where they have been the last 20 years. But you know, people are adjusting. You know, the biggest things are people have money in their homes right now that they want to access and use. And what's the best avenue to do that, right? If they're old enough to access a reverse mortgage, there's an option. If they want to access you know, home equity via a second mortgage, or doing a cash outright refinance, we still see a lot of refinance opportunities happening. Even with increased rates, you know, the return on the investment may be higher doing another option. So we're seeing that across the board.
Great. Let's talk about, for the benefit of our audience, let's talk about the financial incentives for doing this line of business if we can. And I don't mean to be, you know, insensitive about it, but mortgage lending is a business, right? And Steve and Mike, I just want to present a question to you. We're receiving some questions on the type of compensation brokers can expect when they're either closing a reverse mortgage, a HELOC versus a second. Or do either of you have any thoughts about how that could potentially be used as as a way to offer a little bit of carrot to brokers who might be considering wading into either of these waters?
Well, for me, it's pretty easy. So our compensation on our second mortgage mirrors our first mortgages, right? So you can still do, if you're a mortgage broker out there, I assume most of our people on the call today are mortgage brokers. You could do borrower paid, lender paid compensation. You can make your full compensation. We do allow you to roll in things like discount points if they're out there. We can, depending on the program, we can break that out for you, but the compensation is very similar to what you would have on a first mortgage program. So it's very easy. And that's another good comparison point between like a fixed rate second mortgage and maybe a HELOC. Oftentimes I've seen, again, HELOCs, there's a lot of variation there, but a lot of times I see there's not a lot of compensation just because it is kind of thin to the margins as far as how it's set up. Whereas on the second mortgage program, you can make your full compensation. And like I said, a lot of times we're seeing $500,000 loans. So these are legitimate loans that you can make your standard compensation on.
So I would just, I'm not a lender. I'm an association representing a collaboration of competing lenders. There is absolutely an option to work with an origination fee that is capped. But there are also options where you partner with a wholesale lender, and there are a variety of service release premiums available through those transactions. And any more specificity, I would point you to our members who are those wholesale lenders.
Yeah. And I have seen reverse mortgages because there are fixed rate options, right? And there are adjustable rate options and there's some flexibility in that stuff. So I guess you would connect with the right lender and then they can guide you on that path.
Absolutely. Thank you, Mike.
And, saving the best question for last here is what kind of tips and best practices do you have for going after this type of business? Steve, I know in the past we've talked about, reverse mortgages being such an amazing tool for people who are in need of the means. Michael, you mentioned that refis as a way to help with expenses. Certainly the opportunities are out there. And as we see with the equity numbers, quite frankly, these products still have a lot further they could go. They can, NRMLA can add more members, certainly. AD could close more loans. So, and it's not just going to be the temporary high interest rates. What are some business practices so we could get our brokers out there finding success?
Well, if I could just quickly say that, first of all, seniors are a protected class. And so, and I did not mention during my attributes of the product that reverse mortgage borrowers are required to go through independent third-party counseling. So we want to make sure that borrowers and applicants are treated right and that they do get clear and independent counseling. That being said, it's a mortgage. And so we are happy to offer additional education, do a deep dive. I know all of our wholesale members offer a ton of training on processing an application and transfer over to servicing as well. So again, I just think I want to reiterate that this is a great opportunity to add this product to your portfolio of offerings. And again, it's a mortgage with a few nuances, but once again, it's just a mortgage.
Yeah, and just to add, I'll do my part, but just to add a couple of things to that reverse mortgage piece. You mentioned it. I don't think a lot of people understand that you can do a purchase on those as well. I think that's a piece that people miss out on a lot of times. And then another thing that I hear on reverse mortgages, oh, well, what's going to happen if the borrower unfortunately passes away and this house is upside down? And you mentioned that there was a cap to what could be repaid, right? Is it the they're never going to pay back more than the value of the property. Is that the way it works?
That's correct. There is, and thank you, Mike. And sometimes we get these shorter sessions, and I leave out the heck'em for purchase, and that's my bad.
No, you mentioned,
a reverse mortgage opportunity in the purchase market. It's right now hovering between 5 and 6% of production. But we see a lot of enthusiasm for that product. The purchase market will be growing. And yes, the reverse mortgage is non-recourse. And this is what the FHA insurance will cover. At no time would the borrower or the borrower's estate be responsible for repayment any amount that is over the current appraised value at the time the property is due and payable.
Yeah. So that's important. I mean, you do have a lot of seniors relocating right now. So
right.
yeah, it's good to know those points. So on my side, a couple of tips. I mean, we are seeing a lot of people using the second mortgage product, particularly on DSCR products, to pull out equity on those programs and purchase additional properties. We see that quite a bit. That's been a very popular option. Our second mortgage product allows all the doc types that we offer on our first mortgage. So whether that's a bank statement loan or a P&L only loan for self-employed borrowers, a DSCR loan for investment property borrowers, those are options that they have without having to do anything with the first mortgage. So that's a very popular option that we see. Additionally, when it comes to how to access those borrowers, it starts with a conversation. What are the needs? What are they trying to do? What are they trying to accomplish? That starts the whole conversation. Which product is the best fit for the borrower really starts with the conversation of what are we trying to do? How do we want to access the money? Are there other avenues, or do we want to go down a loan product highway and then kind of figure out what's the best fit for them at that point?
And that's a good point, Mike. I'm glad you made it, because we are some of the questions have to do with the access to cash. And sometimes you when you do something like this and you talk about the product first, we do have to remind ourselves that the borrower's request for funds is more important. Like and let's face it, some people, so help them. They might have medical bills that run very, very high, and they need help with that, in which case a refi might be give them more access to cash. So we do have to go to the borrower and see what their needs are sometimes before deciding, overarching that this product is better than that one. So I'm glad you mentioned that. So at this moment, I'd like to point out the QR code if people would like to stay engaged. I know I found this particularly very, very engaging. Mike, I want to give you a chance to kind of see us out now that we've gone through the questions. Again, I'm going to move past this slide, but I do
no worries.
remind everyone that they will get copies of this. So you can access that QR code there. And as you can see, we'll go ahead and let Mike, you want to talk a little bit about the benefits of partnering with A&D?
Sure, absolutely. Well, again, hopefully, everyone got a lot out of this call. We appreciate you taking the time out of your day to go through this. And Steve, thanks for joining me on the call today. Like I said, I took my notes, so I'm ready to go. So I appreciate that education, and I would encourage everybody to get involved in a trade organization that supports you and your growth. That's very important. So as far as partnering with AD Mortgage, we hope you will consider, if you're not already doing business with us, connecting with us and starting down the road of submitting business with us. We think we're a great home for your business. A few topics that are here on the screen. Again, we look to streamline the process. I think we're unique, particularly in the space that we do lending, and our investment in our technology systems partners and the overall process to make sure that you have open lines of communication, you have the easiest process possible, and be able to get your loan into closing as quickly as possible. Let's see, I think we have some on the next slide. We have some upcoming webinars. We do, as part of our education, we do host usually at least twice a month, sometimes more than that, webinars for our clients and partners. So we will do a mid-year review on July 27th. So be looking out for invites on that. And then we do a monthly broker or orientation, excuse me, I can't speak this afternoon, for our new clients, so they can kind of get an idea of what's going on with A&D Mortgage, how to get connected with us, an overview on our systems and website and how to work with us and all of that. And then if we can just go to that last slide, there's our QR that gets you connected with becoming a partner with us. Either scan now, give me a call, or you'll get the presentation and be able to connect with us. But we appreciate all that you do out in the industry, and we'd like to be a business partner if we're not already working together.
Great. I'll go ahead and exit out of the slideshow presentation, and
Thanks very much.
Thank you so much, Mike. Thank you so much, Steve, for joining us
My pleasure.
for our webinar. Let's do it again sometime.
Sounds like a plan.
Thank you, everyone.
Do a deep dive next time. All right.
There you go.
Thank you. Take care,
All right,
everybody.
have a great afternoon.